Hi all, I'm just going to give you a few seconds to enter the room. I do apologize for the 2-minute delay this evening. Just a few more seconds, as I said, and we'll get this presentation underway. All right, it's great to see some familiar names here. All right, so welcome to this webinar on, as you can see, economics, Economics 101. As the title of this presentation implies, this is going to be a basic introduction into the wonderful yet sometimes puzzling world of economics. As usual, I will be throwing a lot of information at you, but please do ask questions if they relate to the slide in being presented, or simply wait until the end. Or if you prefer, you may wish to watch the recording, which is available through the usual avenues. That is through FP Markets, their main webpage under the tab Resources, or alternatively head over to our YouTube channel under FP Markets. Questions missed, or those that require more of an in-depth explanation or a more detailed answer, feel free to email me and the research team at Market Analyst at fpmarkets.com, and we'll get back to you as soon as possible. Also, as usual, please do send across your comments or feedback. And anything you wish, and any topics you wish us to cover in future presentations. Now, a question I do often get asked, and I'm sure I will during this presentation, is whether there is a need to understand economics to trade professionally, or to trade your own account and generate a return on a consistent basis. Now, the answer for me is yes and no. I personally know a number of technical analysts, myself included, that generate a consistent return. But here's the kicker. They do take into account tier 1 risk events. What I mean by this is the major economic data. So think of your inflation, your GDP, your growth data, and your employment numbers. So they're aware of when these economic data are being released, and they plan their trades around those economic events, largely to avoid being in the market when these risk events are released. Because let's face it, they're basing their analysis on technical analysis. They're not really factoring in any fundamental or macroeconomic analysis. Now, I also, on the other side of the spectrum, I also know some technical analysts that combine or blend the macroeconomics with their trading, for both trading and investing. And this, I find, it offers a nice blend to navigate particularly the FX markets. Look, personally, it's all down to preference, or personal preference. For someone to find their way to navigate the markets to generate a return while maintaining a strong hold on risk. As remember, guys, we are risk managers first and foremost. All right, very quickly, guys, this is the usual disclaimer. I'm not going to read through all of this text, but suffice it to say, this is not investment advice. Anything I say within this webinar is not investment advice. It is solely an educational presentation. Onto the agenda for this evening. So, as you can see, we have a number of topics I will be touching on. Understanding the meaning of economics, which is should be obvious. The difference between macroeconomics and microeconomics. We'll also learn about the main economic agents, which is just a fancy term for decision makers. We'll also touch on basic supply and demand. What are the main economic indicators that are released on a weekly and monthly basis? And how can we use economics in our trading and investing? And then, as you can see, we will round things off with a Q&A session if any questions do arise. All right, so jumping straight in, what is economics, or what is an economy? So an economy can simply be defined as an arena or a platform for the provision and use of resources. And economics is simply the study of that provisioning. Economists often use models um, to represent their ideas. And economic models are essentially a simplification of reality. Now, with economics, we look at how resources are provided within the economy for use. Resources, what I mean by resources are the inputs, the factors of production to produce goods and services in the economy for consumers. And these inputs, these factors of production, are generally categorized into four buckets, if you will: land, labor, capital, and entrepreneurship or entrepreneurial ability. And this really leads me nicely on to the next slide, and which is a key issue in economics: scarcity. Scarcity is essentially emphasizing that as our resources, our factors of production, which I've just touched on, land, labor, capital, and entrepreneurship, are finite. They are limited. It's important to decide, or for the economy to decide, how and what to produce with these limited resources to help satisfy the needs and of course, what the needs and wants of consumers, which are unlimited. Look, as humans, we're never completely satisfied with everything we consume. We consume a variety of goods and services, but they are never enough. In other words, there is always something else that you, or anybody else really wants or needs. And with that, there is also a constant opportunity cost. Now, this is something that is touched on early when you study economics, and that is, of course, opportunity cost. Now, this can be defined simply as the next best alternative foregone. We have to forgo producing one type of good for another, for example. And this is why economics study how individuals, businesses, and governments make choices regarding the allocation of resources to satisfy those needs and wants of consumers. And at the heart of this, central to economics is, and the provision of resources, is how we connect with each other, our social relationships. Such examples are worker and employer, government and taxpayer, buyers and sellers within a firm and consumer. And this is why you often hear that economics falls under the umbrella of a social science, which is defined as the scientific study of human society and social relationships. Now, individuals, the firms that provide the goods and services, and of course the governments, are referred to as economic agents. Now, this is just really a fancy term, as I mentioned at the beginning, a fancy term for a decision maker. And when you really think about what economics is quite simply a decision science. Now, through a collection of interconnected decisions, this is what makes up economic activity. This can be from the consumer at your local supermarket deciding to buy apples or oranges, to capital owners, so company owners making decisions, as well as banks and central banks and government. Now, households are the most basic and easy to understand in terms of economic agents. We consume to maximize our utility, which is essentially another way of saying we consume to maximize our satisfaction. So we are responsible for consumption, meaning we purchase goods and services to satisfy our needs and wants. And this is pretty much anyone who is in a household that's going to buy a produced good or service. And firms are another key economic agent, and that what their role in the economy is to produce these goods and services, which are then sold to consumers, and they employ the factors of production. They employ land, they employ labor, they employ capital. Labor are the people working for those companies, and capital is the machines, and the factories that also make up part of the production process, and they essentially employ the factors of production to maximize profit, or if you prefer, profit maximization. Another economic agent, which I will touch on quickly, is the government. Of course, they provide the rules and regulations on how firms and consumers should really interact. Government provides law and order. They also deliver what's known as public and merit goods for the wider economy, and attempt to correct for what's known as externalities and inequalities. I just think, bear with me, I was just checking if I had any questions there. So for those unaware of what a public good is, this is essentially a good that is non-rivalrous and non-excludable. So a non-rivalrous good means that if one person consumes that good, it does not prevent others from consuming it. And non-excludable means that it's costly or impossible for one user to exclude others from using that good. All right, so I think that's enough regarding economic agents. Let's move on to economic systems. Now, I'm pretty sure, even if you haven't studied economics or anything like that, you have heard of these economic systems. And as the name implies, this is a system that combines the market and the government to produce and distribute the goods and services to meet the needs of the wider economy, meet the needs of the consumers within the economy. So an economic system looks at what goods and services should be produced, how they should be produced, how much of it, and from whom. There are three main types of economic systems which we will touch on. That is your command economy, your market or free market economy, and also the mixed economy. Now, just to be clear, to my knowledge, I do not believe there's ever been a pure system used. Certainly not today. There's no pure system used today. There are no pure command economies or pure free market economies. They all fit between these two economic systems, which should become clearer shortly. All right, so command economy or a planned economy, so it's a centrally planned economy, is when the government control all major aspects of the economy and economic production. A command economy, think of a command economy as an umbrella term for any controlled economic system, which encompasses socialism and communism. So imagine we have an economic spectrum, and at one end we have the communism. On the far left, and on the far right, we have the free market economy. Now, in between these two economic systems, we also have the socialist economic system, and also the free market economic system. So in this situation, regarding a centrally planned economy, the command economy, it's the government that decides what goods and services should be produced, how it should be produced, how much of it should be produced, and from whom. So in a controlled economy, a command economy, excuse me, the government owns some or all of the industries producing goods and services. Now, just briefly, communism supports absolutely no private ownership, with socialism supporting limited private ownership, which is vastly different from the free market economies, which advocates for total private ownership. Now, the two terms, socialism and communism, are often used interchangeably. This is partly because of both socialism and communism emerged as a critique for capitalism, for the free market economies. And both these systems, what they do is they seek to limit worker exploitation and lessen, essentially try to eliminate the influence of economic classes within a society. However, both communism and socialism are not the same, despite them both terms being used, as I said, interchangeably. What is the difference? The difference between the two is that communism, an economic system, is attempting to offer a highly essentially utopian nature where private property is entirely abolished, and all property is owned communally. In this society, there is no need for money, because as wealth accumulation and private ownership ceases to exist, and the economic output is distributed according to the people's needs. I hope this is making sense. So for instance, you can think of a pure communist society as classless, moneyless, and stateless. Now, there has never been a communist country, as far as I understand, a pure communist country. Today, especially, that's where I'll leave it, I think, because a communist country, I've never really come across a pure communist country. But in terms of socialism, in terms of a socialist economic system, we have that's still prevalent within even developed market economies such as the UK and the US. But these fit more into a mixed economy, which we will touch on shortly. So with a socialist economic system, we have things like universal healthcare, public schools funded by taxes, and numerous other welfare programs which are consistent with the socialist ideology, if you will. All right, so moving on to the market economy. This is the free market economy, and this is where the factors of production, again, land, labor, capital, and entrepreneurship, are owned by private individuals. Now, decisions within a free market economy are guided by self-interests, profit maximization, and the resources available to that business. So the free market, determines what goods and services should be produced, how it should be produced, how much of it, and from whom. The goods and services that are produced this is vital, guys, are not determined by the government as they are in a command economy. Rather, the production is determined by businesses responding to the needs, wants, and desires, if you will, of consumers. Now, if I may, you may have heard of Adam Smith, who's often regarded as the first economist. In, I think it was 1776, he released the book The Wealth of Nations. Now, do read this if you're interested in learning more about economics. And this is where he touched on the free market economy as is controlled as if by an invisible hand. Producers produce the things that consumers want without government telling them what to do. This expression, the invisible hand, is that it really says that if the economy allows people to pursue their own individual self-interests, the results will be far better for society. Producers who want to make as much profit as they can will have to produce the things that consumers want. Profit, therefore, is an incentive within a market economy for producers to satisfy the needs and wants of the consumers. Finally, guys, mixed economy. Now, this is a combination of, or a blend of, the market and command economies. Now, in a mixed economy, there are some parts or sectors of the economy that are left to private ownership, so the free market economy, while in other sectors, substantial government ownership or government involvement is present, which is in alignment with a socialist economic system. So in a mixed economy, government intervenes in those sectors. It has a presence within those sectors, and it is believed to be in the best interests for society as a whole. Now, as I said, there are mixed. I think I've already related this. There are mixed economies are relatively common nowadays. Countries like here in the UK, the US, Germany, France, Russia, and China currently do have mixed economies, which is a blend of, a blend of a market economy and a command economy or socialist economy. All right, so moving on to macro versus micro. Now, I'm pretty sure you've heard of the traders and investors speaking about the macro picture, especially in the FX market. That's all we really talk about in the FX space is the macroeconomic picture. You know, your GDP, your growth contracted, growth expanded, inflation has eased, and unemployment's rose. We all hear that in the financial media. Then this is your macro analysis. So microeconomics and macroeconomics are interconnected. They with one another, but at the same time, they offer different approaches to studying the economy. The best way to describe macroeconomics is that it is a practice that looks at the economy as a whole. We focus on questions like, has the economy grown? Has it contracted? Is employment rising? Or are prices stable? Are they falling? Are they rising? For example. And we also take into account with macroeconomic analysis, we take into account what the central banks are doing. Are they hawkish? Are they dovish? Are they raising rates? I mean, look at the Fed. We're looking at a pause next week, but they have been on an incredibly aggressive policy firming schedule, as have the Bank of England, who are, by the way, looking to potentially raise rates next week. So for microeconomics, we look at the interactions between individuals and businesses. So macroeconomics looks at the supply and demand for say, real GDP growth, and microeconomics looks at the supply and demand for a particular good, such as cars, essentially individual markets. And this leads us nicely on to the subject of supply and demand. Now, as a technical analyst myself, I do look at supply and demand on a chart, but I also understand that there's a law of supply and demand, which I will go into shortly, relating to economics. And what we will be doing is discussing the idea of equilibrium. So where supply and demand curves intersect. Now, I understand that some of you may not have had much experience with supply and demand in terms of an economic in an economic context. So I have tried to keep this as simple as possible. And what we'll do is we'll largely stick to a microeconomic demand and supply model. So we'll focus on the supply and demand of a consumer and a firm. Though do be aware that models do exist. Models do exist for to express macroeconomic states such as the real GDP and the overall price levels for the wider economy. All right, so I'm pretty sure most of us have seen this at one point in our lives at least. And this is a demand curve. And again, I am going to be only focusing on the microeconomic context here. So for the demand curve, as the price of a product increases, this is, as you can see here, let me just describe this quickly. So we have the price on the y-axis, the vertical axis, and we have the quantity demanded on the x-axis. So as the price of that good increases, what happens generally, the law of supply, the law of demand states that quantity will be reduced. So the quantity demanded, as pretty much common sense, right? So if the price of a good increases, quantity demanded will generally decrease. And as you can see, it's an inverse relationship. As price rises, quantity demanded will decrease. As price decreases, quantity demanded will increase. And this is depicted or expressed using a downward-facing straight curve here. This is your demand curve, and really expresses this nicely. So we have P1, Q1, quantity demanded. Should be really a subtext 1 and subtext 1 here. But we have price at, say, P1, quantity demanded at Q1. But if price actually drops to P2, what you'll see is the quantity, as you can see, if you extend that across to your demand curve, you will see that quantity has actually increased. Now, the point here is where your equilibrium. So this is where demand and supply merge. This is your equilibrium. So just trying to think of an example. As a quick example, should we see a shift in demand, say, for apples? As preferences change to say like oranges or something like that, you can actually see a shift in this demand curve. So at this point in time, we've only spoken about price and quantity, and all we're doing is we're looking at an extension across the demand curve. But you can also see a shift in the demand curves, both rightwards and leftwards. So as the basic example, say for example, we demand for, as I said, apples, preferences change to say oranges. So this is the demand curve for the apple market, so a certain brand of apple. Now, in this case, you will see if consumers start to move away from apples and they prefer oranges, what you'll see is this demand curve shift to the left. So you'll see a demand curve shift to the left here. I'm attempting to try and simplify this so I don't leave too many confused, but the demand curve will shift. And what that demand curve will express is you'll see the quantity decrease for every price level. So let me try and draw this on. This might be easier, actually. Let me draw this on. So if we see a demand curve shift here, that's better. So what you'll see at this point, so we've shifted to the left. All right, so we've shifted as consumers reduce their quantity for this apple, as this certain brand of apple, as they're now preferring these oranges. What you'll see is a shift leftwards. So a shift leftwards in demand. And this would see, as you can see, the quantity reduced for this type of apple at P1. So instead of being over here, your new equilibrium would be at this point here. And for instance, at P2, it would no longer be here because your demand curve has shifted to the left, and your new equilibrium price would be here. So you've seen it's essentially a reduction in demand. Now, for let me see. I think I've covered everything. I don't see any questions, so I do hope I explained that as clear. If not, do ask away, and I'll try and explain more regarding this. Now, for supply, it's essentially the same, but we have a rising supply curve. And this is an increasing line, and we see it's essentially, with the demand curve, we have an inverse correlation. As price rises, quantity demanded reduced. So we have an inverse correlation. One goes up, one goes down. But with the supply curve, as price increases, say from P, this is around the wrong way, but say from P2 to P, say we increase from P2 to P1, supply will increase. So from Q2 to Q1, generally it's Q1 to Q2. But all right, so if price decreases from P1 to P2, supply will reduce. So, and how this can be explained is, so as the price rises so this is a firm. So this is the firm that supplies apples. So as the price decreases for apples, for example, this reduction in price will lead to suppliers being unwilling to produce a higher number of we'll see them at less. We'll see less is supplied at the lower prices because there's less profit maximization opportunities. But a higher price causes an extension across the supply curve as more is going to be supplied as firms want to maximize their profit. I won't go into details regarding a shift in the supply curve because I feel like I will confuse further regarding this, but nevertheless, let's just recap on the demand. Whoa, sorry about that. That shouldn't have happened. Just bear with me, guys. Sorry, I do apologize about this. So here's the demand curve. So essentially, as price increases, the quantity is reduced. As price decreases, quantity is usually increased, and that's the law of demand, ceteris paribus. So that's keeping everything else constant. I don't know why that's happening. Why? Sorry about this. The supply is just gone. I apologize, but look, with the supply, there's a correlation. So as the supply increases, as the quantity increases, as the price increases, this will tempt more suppliers to produce that good and at the higher price as they desire. They seek profit maximization, and if the price decreases, it will have the same effect, but to the downside. So that they'll produce less goods for that price level. Let's move on. What are the main economic indicators? So the main economic indicators that we should all understand are GDP, that's gross domestic product, inflation, and the unemployment rate, which are all considered lagging indicators that help verify that a shift or a change in the economy has occurred. This is unlike the leading indicators, which tend to change before the economy has turned, like the stock market, new orders, or manufacturing, or even the initial claims data, the weekly initial claims data for the US. Now, the main objective I'll just quickly go over what GDP is. Now, the main objective of the GDP number is to provide us with a single value, a single number that summarizes the dollar value of economic activity over a given period, which is usually, say, a quarter or a year. Now, in the US, if we're talking about the largest economy in the world, the GDP is actually released in three estimates. So we have advanced, preliminary, and final. And this is a month apart for the previous quarter. So just bear that in mind. The advance report for the GDP, especially for the US, tends to garner the most attention as it's the first snapshot of the previous quarter's economic activity. Now, moving over to inflation, really, inflation is about the overall level of prices in an economy. It measures the rate of change of these prices. It essentially gives us an average cost of living for the typical consumer. So essentially what we're looking at is whether prices are increasing or decreasing. Now, inflation has three phases, really. We have inflation, which shows the prices increasing. We have disinflation, which shows prices are increasing, but at a slower rate. And then we have deflation, which shows that prices are actually falling. So right now in the US, we are not seeing deflation. Do not confuse that with disinflation. Disinflation, we are now in a disinflationary phase in the US, especially, where prices are increasing compared to the year prior, if we're looking at the year-over-year measure, but they are increasing at a slower rate. Now, if we move over to the unemployment rates, just really quickly, the unemployment rate really gives us insights into the health and the health of the job market within the broader economy. Now, the unemployment rate is essentially offering us a percentage measure of how many American citizens, if we're talking about the US unemployment rate, a percentage of the labor force. Now, labor force is the sum of employed and unemployed. So what we're looking at is a percentage of the labor force that's currently jobless, which is technically defined as someone that's sought employment in the last 4 weeks that ends in the reference week. Now, if you look at the Bureau of Labor Statistics, their actual methodology, it's in the 4 weeks leading up to the reference week, which is usually the month that has the 12th day of that month. So it leads up to there, and then following that, we have what's known as an interview week, which is where the economists from the Bureau of Labor Statistics then contact those that were surveyed. All right, so that's really it for the main economic indicators. So the big three, really. We have GDP, we have inflation, and we have the unemployment rate. So keep an eye on those their main economic indicators. Now, how can we use economics in our trading and investing? Now, I'm largely referring to FX trading here, of course, because I'm primarily focusing on macroeconomics here. What you will find is that traders and investors, they combine macroeconomic analysis and technical analysis. So they form a strategy that combines both of those analytical approaches. So macro analysis, so a top-down approach, focuses on the broad economic influences. And this involves a comprehensive assessment of the economy, evaluating things like the central bank policy. Are we hawkish? Are we dovish? Are we looking to hike? Are we looking to cut rates? And then we look at aspects such as economic indicators, which I just touched on. So and we also look at interest rates as well, as I've also touched on briefly, interest rates from the central banks. So fundamental analysis for me particularly is composed of three key elements, and that is central bank policies, economic indicators, and of course, geopolitical events. Geopolitical events can be very, very difficult to trade, especially for me. That's just my personal opinion. I've not had any luck trading geopolitical events. I just really what I'm looking for is these three components: central bank policies, economic indicators, and geopolitical events to work in harmony. So we should see clear trending environments should the central bank policies, the economic indicators, and the geopolitical events all favor one direction. And these should, as I said, they should produce clear trending environments, and offer ample opportunities to trade. So buy the dips in those trending higher and sell those rallies in downward facing markets. Now, if one of these areas are in disarray, so think of geopolitical events, this can cause an issue and make it more difficult to interpret a clearer fundamental picture. Now, what's important to note is that the economic indicators, so think of GDP, as I've said, GDP, inflation, and the unemployment rate. We also have manufacturing. We have a number of economic indicators that are released on a weekly and monthly basis. These economic indicators create a short-term bias in the markets, but the central bank policy, the central bank creates that long-term trend. So the best trading opportunities that I've found is when we can, is when we find the economic indicators are released in harmony with that longer-term bias. So we have positive GDP numbers, and the central bank policy favoring a hawkish bias. That's not to say that there are not short-term trading opportunities against the overall trend. You could see weaker economic data as buy the dip scenarios within the longer-term trend if the bias is to the upside. So with the Fed, for example, with the Fed looking to raise rates, a dip in price fueled by a softer US data print. So we could see a dip lower, and that could open the door for a dip buying opportunity into that market. And this is where technical analysis comes into play. Once we have that fundamental direction in mind, and this is where technical analysis can offer you an opportunity to time your entries. It can offer you good entries. It can offer you ways of exiting the market. So what I mean by technical analysis strategies, you can go as basic or as simple as you like. So as an example, a very basic technical analysis strategy would be, say, including the moving averages with trend line support and resistance. This is just off the top of my head. So trend line support, you could try and fade those trend line supports if you are underpinned by a fundamental bias, if that makes sense. You can also use support and resistance. You can use those supply and demand areas. You can use Fibonacci analysis. You can use advanced harmonic analysis, which is a branch into, I guess, Fibonacci study as well. If you're interested in harmonic analysis, I would recommend a gentleman who goes by the name of Scott Carney. No affiliation at all to his work, but he really does help explain advanced harmonics very, very well. And if you're interested in Fibonacci studies, I would recommend the Fibonacci Queen. She is absolutely awesome. How she explains how Fibonacci truly works and the correct terminology for that. Also, if you're interested in Fibonacci, we have a number of webinars here with FP Markets that I've presented regarding Fibonacci strategies and the harmonics as well. Just head over to our archived section, and you'll find those webinars available. All right, so that's thank you very much for taking the time to join me this evening. Are there any questions? I don't think there are any questions. If there are, the support team have covered them. Look, guys, I would really encourage you to check out the Trading Hub. We have an active Trading Hub that's with daily posts, market analysis, fundamental analysis. We also have the First Light News, which is a daily market briefing that really covers everything that you need to know for the macro space for the day ahead. You will see links in the chat box there. We also have a Trading Academy. Has everything there from videos to in-depth articles. Certainly something I would recommend you paying a visit to. Now, our next webinars for this month is on Monday, the 26th of September, and we'll be deep diving into the derivatives market. So I'll be touching on all those good things like forwards, futures, swaps, options, and of course, CFDs, contracts for differences. I'm just going to check once more to see if we have any other questions, and it doesn't look like we do. Okay, once again, thank you very much for your time today, and I will catch you all again very, very soon. Have a wonderful evening, or morning, wherever you're joining us from, or afternoon. Thank you very much. Goodbye.